Hi, I'm Mark Stephenson. I'm the Director of Dairy Policy Analysis at the University of Wisconsin. I want to talk today about the outlook for dairy prices in 2021, and I'll do that by asking questions such as, really, is 2020 in our rearview mirror? We've had quite a year this past year, and we'll go over a few of the impacts that we saw and have to wonder whether there are residual impacts that are going to be carried forward. One thing that we ought to look at and just ask ourselves a good hard question about is whether or not COVID is behind us. This graph is showing you the number of daily new infections over time. And you can see here, it wasn't until the end of February that we began to detect COVID in this country in any meaningful way. And our first wave of COVID looks like that bare bump out there in the middle of March. And we beat it back at that point in time. We had our safer at home when we had lockdown here, and restaurants all closed, schools closed, and a contraction in our general economy during that time period. Big impacts on the farm as well. But with COVID did respond to that. And then as we began to relax a little bit, begin to open up at least partially restaurants in some parts of the country and other um, uh, times to get out and move amongst the people, we began to see a second surge, a wave that peaked in July. That became a real concern for us, and mask wearing became more normal during that particular time period. And again, we've pushed back on the COVID and we reduced that through the middle of August. And then we began to get lax. We really began to get tired of staying at home and keeping our masks on, and we began to slip out into parties or go and do things that eat in restaurants that we hadn't done before. And this big third surge has been amongst us. We've hit 300,000 new cases, or essentially 300,000 new cases a day as we got toward the end of it. But as you look at this graph, there's actually maybe a small amount of optimism we can see in these last couple of weeks in January, where it appears as though we may have hit our peak and starting to reduce that. Long way from being over, but maybe we've turned the corner. We'll have to wait and see. The dairy markets have done a remarkably good job of moving milk to meet consumer demand. Everything in supply chains got disrupted, not just for dairy, but everything else. And, cheese was no exception. Historically, about half of our cheese is consumed in out of home eating. And when we aren't eating out of the home, that's obviously going to be impacted. Take American cheese as an example. That processed cheese is made into those singles patties, that get put on hamburgers to turn them into a cheeseburger. And that's almost entirely through fast food service. So when those restaurants are closed, American processed cheese plant demand went to near zero for a short period of time. But we've had other products like mozzarella cheese that's had surprisingly strong sales. The majority of pizza is takeout anyway, either through curbside pickup or delivery. And those sales have surged as we've been hungry to eat something that wasn't just prepared at home. We've also seen domestic demand from new sources like the farm to family food boxes. We've had 5 of those waves, or 4 that have been completed, and the 5th one that's just going to start shortly. That's had a big impact on cheese sales too. Total cheese consumption at resale has been way up during this time period. More recently, it started to decline a bit, not below year earlier levels, but the rate of increase has been slower. But if you look at the total commercial disappearance numbers and use of cheese, it was down only for the year about 0.4%. That's not too bad considering we expect to be down much more than that. This is a graph that's showing you the commercial disappearance of cheese over time, and generally speaking, we like our cheese. It's been trending upward. In fact, Americans are consuming about 38 pounds per capita per year at this point in time. Back in the 1970s, that number was down around 14 pounds, so you can see a big increase. But if you look at this graphic, look here at this slot. This was our safer at home time period when we were closed down. And cheese plants still took in milk. They were making cheese product, but it was for an unknown customer because we just simply couldn't sell all of that product. It was accumulating in cold storage. Since that time period, we've had opportunity to bring cheese out through some different channels, and we've moved that to stronger levels of commercial disappearance. Let's take a look at another market, fluid milk. The story on fluid milk has been kind of dismal since about 2010. Total fluid milk sales have been sliding and pretty precipitously. But you'll notice clear over in the bottom right-hand corner that we've had a little bit of a bump. This is due to COVID. Since about 2/3 of milk is consumed at home anyway, as people stayed at home, we had fluid sales that were well up from retail. And as we put that extra gallon of milk in our refrigerators, we've used them. COVID cooking is a real thing. So COVID sales and cold cereal sales were up during this time period. Reports of empty store shelves were short-lived. The markets have also been moving quite a lot of butter. Half the butter is consumed in out-of-home eating, certainly at higher-end restaurants where we expect to see that, but even in fast food restaurants, chains like McDonald's have begun to use butter quite a bit more in the last couple of years, and that butter sale, of course, through institutional uses and restaurant uses is gone when those restaurant sales are stopped. So that's been a concern. But retail sales of butter have been off the charts, at least through July. We've moved a huge amount of butter through purchases directly to our home refrigerators and have been using it in our COVID cooking. Retail July to the present time period has still been up, but it's been up at a slower rate. If you look at total commercial butter disappearance, it's only down about 0.2% for the year. When we were experiencing large milk production increases in 2020, the red line here, in the first quarter of the year, the last quarter, the fourth quarter of 2019, was pretty good milk prices, and it stimulated producers to want to make more milk. And they were doing just that. But when we had COVID in April and May, we had our safer at home lockdowns, and we even had reports of milk dumping as plants simply couldn't handle all that milk production when demand collapsed. Base excess plans were put into place by dairy co-ops, and even proprietary plants simply said, I can't buy all the milk that I did before, we'll have to reduce that. So you can see the jog in the chart here where milk production declined in May relative to the track it had been on. After that, however, we kind of got back on target, and we've been increasing milk production quite a bit. I'll talk more about the percent increases in September, October, November a little bit later. Pandemic prices have not been as bad as we expected, but I don't know how much milk production we can actually handle. Milk powders are clearing the markets, but butter stocks, although they've been drawn down, are still large and growing. Food boxes have really caused some tightness in cheddar markets as they've had that unusual and big demand all at once. But those markets have swept out some of that fresh inventory that accumulated when we saw commercial disappearance decline rather rapidly in April. We had huge swings in cheese prices. In April, cheese prices got as low as $1 a pound at the Chicago Mercantile Exchange spot markets. That also caused a big surge in export sales for a short period of time because our $1 a pound cheese here was well below the $1.80 or so that so-called world markets were for cheese. And we sold that. We tightened up our milk supply through the base excess plans. We had some farm-to-family food boxes, a few other things going on, and all of a sudden we had tightness in cheese markets, and we went 6 weeks later from $1 a pound cheese to $3 a pound cheese. That was the highest price we've ever seen on the CME. So that $3 a pound effectively squashed those export sales of cheese because it was well above market clearing levels for those exports. A concern that we have is that this COVID has induced worldwide recession. Not just here in the U.S., we're certainly in recession right now. Technically, that's 2 quarters of negative gross domestic product. But much of the rest of the world is in recession because of virus-induced supply chain disruptions. take a look at the unemployment rate, you'll see here that our Great Recession happened during 2008 and 9 when our unemployment rate rose to the frightening levels of 10%. We fought it back over the last many years. We got down in 2019 to rates that were below 4% unemployment. That's considered full employment here in the US. But then COVID, of course, had us at home, and many of the restaurant and service sector jobs or hospitality industry, people were laid off, and we went immediately to 14% and above. Now we've declined rather rapidly, but I think that we're plateauing again, and we're at a level of about 6.7% for the last couple of months. This is well above where we should be for a highly functioning economy, and it's going to take some time, I think, before this gets back. Interesting to me that the Fed, who tries to target interest rates, manipulate the money supply, in order to usually keep inflation at bay, has now decided inflation's not the thing they want to monitor. Rather, it's the unemployment rate. So they'll keep the interest rate low as long as we have unemployment that's too high. But at some point in time, when unemployment comes back down, our interest rates will be going back up. I want to focus on one segment of our economy, though, and that's the restaurant segment. Important to dairy, of course. As I said, half of food is eaten out of home. This restaurant performance index is a questionnaire that's filled out by restaurants every month. They ask them, how many meals did you serve this month? Were they at the high end of your menu or at the low end of your menu? Did you employ more people or did you employ less? Have you invested capital in your business or not? It's meant to construct an index so that a value of 100 or above is growth in the restaurant segment. If it's below 100, it's contraction. You'll notice over here during 2008 and 9 that our Great Recession really pulled this restaurant performance industry down. But if you look clear over on the right-hand side, COVID has pulled this restaurant performance index down further than it was at the bottom of the Great Recession. So it's hit our restaurant sector really hard, and we've all heard about how many restaurants have closed during this time period and probably won't reopen. Let's look at another measure of the economy, though, and this is consumers' confidence in the economy, called the Consumer Confidence Index. This is a questionnaire that's randomly asked of people about how do you feel about the economy today, or how do you feel about the economy in the near future. And based on those responses, this index is constructed. Notice back here, our Great Recession, we had a big plunge in that consumer confidence index right on into 2009. In fact, below 30 was a level we had never seen before until that recession. You can see clear on the right-hand side that we have dropped down from the high level that we were at with our consumer confidence index through this pandemic, but not at the low level we were at during the Great Recession. So in general, consumers are more confident about the economy than they were during the Great Recession, even though they've dropped off from the peak before the pandemic. This is a different kind of recession. In 2008 and 9, it was all about the decline in asset values. So for example, home values fell rather precipitously and mortgages got upside down. We also saw stock market decline quite precipitously. Those are assets that declined in value during the time period, and it had a greater impact on the wealthy than it did on those who don't own homes or don't have a big stock portfolio. This pandemic recession is about job loss. And that has a greater impact on people in the service sector, the baristas, the restaurant waitresses and cooks, and in the hospitality sector. All of those kind of things have experienced job loss, and this has been at the other end of the spectrum of wealth. So in general, those folks that are out of jobs now are not people who had home values to decline or their stock portfolio to be reduced. This is an impact on dairy demand going forward if people stay out of work. Why? Because we're largely in a consumption-based economy. The U.S. generates about 70% of its GDP just through consumption. This is in stark contrast to countries like Russia or China, where a big proportion of their GDP is involved with investment in infrastructure or manufacturing. There's nothing that's right or wrong about either one of those things, consumption or investment, but it does have a different impact on the gross domestic product when consumption tends to fall during these time periods. So it's interesting to me that the Fed has decided to track unemployment rather than inflation, because they understand that unemployment will impact GDP much more so than a decline in asset values did. If we can't sell it at home domestically, then we're going to have to export it. This graph on the left-hand axis and in the blue line is showing you the percent of milk production that's exported. And currently, it's up around 16%. So we're exporting a lot of our milk production. But there are some ups and downs in that line. The green line, and measured off the right-hand axis, is the U.S. all milk price. And I try to draw your attention with the yellow bars in the background here to the correspondence during time periods when the milk price is relatively lower or has dropped. And that tends to be when our exports fall off. If you go back and look at, say, 2009, our last recession, this was a worldwide recession. And the rest of the world wasn't buying dairy products as they couldn't afford them. And those dairy products stayed on our shore. And when we have to clear the marketplace with a lot of product domestically, it means that that product price is going to be low, and so too are milk prices. You'll see that we have been in the doldrums as far as the U.S. all milk price is concerned, while exports have been off their peak and been kind of drifting around in that 15-16% range. That probably will need to be higher than that before we have a substantially sustained higher price. Here's what happened. We aren't selling butter overseas. We're selling a lot of it domestically, but milk fat was high in our milk supply this year. We churned a fair amount of butter, and those stocks in 2020 were well above where they'd been in 2017, 18, or 19. So this is showing you that we're carrying some surplus butter stocks out here. Those are going to have to probably be pulled back down to more normal levels through some export sales, which means our prices have to be aligned with competitors. This graph is showing you in the red line U.S. price per pound of butter. It's currently about $1.44. And it's also showing you our competitors in the green line, the European Union, and the blue line, Oceania. And you'll notice that there are time periods like 2019 when our prices are well above our competitors' prices. And in fact, in 2019, we imported a lot of butter into the U.S. This year, our prices have been much more competitive. Those imports have essentially stopped. And you'll notice now that our butter prices are a little more than competitive. And I think we'll be exporting some butter fairly soon and work those stocks down. Cheese prices is a similar story, except that, boy, when we're above $2 a pound, we're well away from our export market opportunities. We aren't going to sell cheese at those kind of prices, but as cheese prices come back down and get in the competitive range again, we may be able to move some more cheddar cheese product as well. Skim milk powder prices were always competitive. We sell more than half of our powder in this country as an export. Those are what are clearing our markets, and those prices have to remain competitive. Right now they're very competitive, and we're selling a lot of powder. We've had some months when almost 75% of U.S. milk production, or of skim milk powder production, has been exported. When you take a look at the U.S. and major exporting countries, you'll see that our milk production patterns, they kind of go up and down somewhat together, at least in the large movements out here. And that's because we're all facing similar prices out here. When the prices for milk aren't good, we aren't producing as much milk. When the prices for milk worldwide are high, then we all export a little bit more and production comes back. You'll notice here in 2020 that there's a deep V groove in both the red line in the US and in the rest of major exporters, the gray line. That was our safer at home and when the pandemic was at its early peak. Since that time period, US and world milk production has been coming back, but the US even stronger than our major competitors. When we look at percent change in US milk production on a monthly basis, that's what this graph is showing you. It's normal for us to have milk production increases in a 1 to 2% range. And in fact, we increased demand for dairy products in the US domestically roughly 1% or a little bit more than that even. So we need some growth in milk production just to sustain the kind of demands that we're seeing. But when we get well above 2% in milk production growth, it means that we've got to have growth in exports or else our prices are going to have to collapse until we get those export growth. And we're now up in the 3% range at last milk production report. This is a lot of milk and we're going to have to probably see lower prices to move it. When we had our safer at home and our base excess plans being imposed, you can see that one of the strategies that was employed by dairy farms was to cull cows. In March, April, May, and June, we had a reduction in the number of dairy cows in the red line there. But from June until the present time period, the prices have been good enough, the milk income has been good enough that it stimulated addition of dairy cows. We're adding to our capacity to produce milk. Another strategy that was followed by dairy farms was to create a less dense energy ration for dairy cows and reduce milk production per cow per day. Notice that the normal pattern of milk production was off in May, or milk per cow was down, and that's because we reduced that ration. But it's been coming back ever since, and we've had a pretty strong increase in milk production per cow per day. So taken together, more cows, more milk per cow, it's a lot more milk on the markets. If you look across the country, it's probably easier to see where states have decreased milk production than it is to account for all the states that have increased. The biggest increases have been through the central part of the plain states from South Dakota all the way down through Texas. California has even had a very nearly 2% increase in milk production. As our largest state, that's a lot of milk. So over time, the futures markets have been distilling all this information. This chart is showing you the January contract for Class 3 and 4 futures prices. Class 3 in the blue line, Class 4 is the green line. Notice the Class 3 price, the opinion for January prices, was increasing from about $16 to over $18 in November, early part of November, and then declined rather sharply back down to 16 and has been a little up, a little down, a lot of volatility in there. That's because we've been getting a lot of information, new information thrown at us. Too much milk production, prices decline. Building stocks, prices decline. Family food box or farm to family food box program, prices increase. So there's been a lot of ups and a lot of downs. Class 4 has been much more stable, but that's because that's sitting there at world prices and clearing our markets with exports. So I guess part of the trade-off is, do you want higher prices that are volatile, or would you prefer somewhat lower but stable prices? We may have to explore those options later on. As far as my forecast goes, these are the positive factors. I've got optimism about the 5th food box program that's just being implemented. That's $1.5 billion that's being spent on agricultural products for food boxes. Maybe between $300 million and $500 million of those dollars will be spent on dairy products to fill the boxes. So, there's going to be a substantial additional purchase over the next 3 months for that food box program. Grocery store sales have been strong. They've cooled off a little bit, but they're still above year earlier levels. Restaurants and schools are trying to reopen. So some of those institutional sales are coming back. We've got some level of back to work and a new version of normal, and export opportunities are popping up every now and then. What we really are hopeful for, though, are our COVID vaccines that are coming online, and we're beginning to get deployed here. With better testing, better contact tracing, and better vaccines, we may get COVID under control, and then I think we'll have real optimism about the economy. But even when COVID is under control in the near future, we're still likely to have worldwide and US recession. That's not going to go away quickly. It's going to take time for us to rebuild all the money that we've spent on pandemic stimulus programs. So it's going to take a while before we actually pull out of our worldwide recession, I think. We also have new capacity for Class 3 production. One of the real headlines we've seen several times is this large new plant in the center of Michigan. This is a cheese and whey operation that will be processing somewhere between 6 and 8 million pounds of milk a day. A lot of milk going into that new plant. That's a lot more cheese to be putting on the markets. Also in the I-29 corridor, there are a couple of plants that have had substantial expansions there, and one plant in Wisconsin's had a substantial expansion. And across the country, there have been many other plants that have had more minor expansions, but it's a lot of new cheese capacity. That's good in terms of taking more milk from our farms, but we've also got to find the markets for the cheese product. I'm concerned that this much more cheese on the market could imply that Class 3 is going to be clearing the market at something closer to world prices than at the prices well above those levels. So here's my price forecast. The dashed lines or the dotted lines out there on the right-hand side are what I'm forecasting. The blue line is Class 3, the green line is Class 4, and the red line is the U.S. all milk price. Now notice, by the time we get to February or so, I've got these prices kind of flattening out and Class 3 and 4 coming closer together, convergence. Do I actually think that these prices are likely to be quite level and stable? No, I don't. But frankly, there are so many things that are up in the air that can happen at any point in time that will cause volatility that I just don't know when that's going to happen or how big the impact might be. But I do think that we can be looking at prices that are perhaps as good as or maybe even a little bit better than they were in 2020. The income for milk, the net income for milk, was better than we thought. The blue bars on here are showing you the U.S. all milk price over time, the average annual yearly price. The red bars on top are showing you what the net dairy margin coverage program would have been at the 950 level. In other words, the net payment had that program been in play. Now, obviously, dairy margin coverage didn't exist over all those years, just 2019 and 2020. But if it had been in play, you'll see that there were some substantial payments that would have been made under that program. It's a good program and it pays out more years than it doesn't. In fact, only 2014 was a year when it wouldn't have made payments. This year, however, 2020 just passed, we also had substantial payments coming from the pandemic stimulus programs. The CFAP payments to dairy producers, direct payments, averaged about $2.45 over all milk production for the year. This gave us an average U.S. income of about $21, more than $21 in the United States. And that was the highest level of milk-related income that we've had since 2014. These better prices in 2020 have helped stem the loss of dairy farms, or at least slow down the loss of dairy farms. In 2019, you'll notice at the end of the year, the orange line, and the beginning of 2020, we had a couple of months in the state of Wisconsin when we were losing 10% of our dairy farms on an annual basis. The better prices, the better incomes over 2020 and on into 2021 already with the first month of January are showing you that those attrition rates have slowed substantially. In fact, they're now just below 5%. So we're very pleased to see that happening, but we're still losing more farms on an annual basis than we would like to. Dairy Margin Coverage Program has been a good program, I think, and it's paid dairy producers in the last couple of years quite a bit. If you look at the forecast going forward, the dashed line on this chart is showing you where we expect the margin to be. It would show that almost all months in 2021 we would have payments at the 950 level and even below. In fact, another way to look at this is what's the probability or the likelihood of a net benefit that you more than cover the premium cost at different levels of coverage. So at the 950 level, it's almost 100% probability right now. Same thing at $9 level and on down. When you get below $7, it probably is not going to pay for coverage there. And in Tier 2, there's really a very low probability of net benefit. Real question is, did you manage your risk? I think that DMC is a no-brainer, that most farms should be signing up for all the Tier 1 coverage you can get at the 950 level. The last stimulus bill that was signed had a little piece in it that indicated that dairy farms would be able to increase their historic production up to a level of 5 million pounds. This is good news for smaller farms. If you had, for example, a historic production of about 2 million pounds, based on your average production in 2013, 14, or 15, then, and you have increased to maybe 4 million pounds over this time period, you will be able to increase some of that additional 2 million pounds that you couldn't get coverage for. I think that the program is going to be about 75% of the increased milk production. So you wouldn't quite be able to get to 4 million pounds for that example that I just gave you, but maybe 3.75 million pounds or so. So that would be a substantial increase and a help. For larger farms or milk production that's above the 5 million pound Tier 1 levels, you want to watch for opportunities in futures markets. These price opinions have been moving around a lot by dollars over the course of a few months' time period. Look for opportunities out there in more than a quarter out for the Dairy Revenue Protection Program. If you see a good price average for a quarter, then perhaps you can put a floor under some of your milk production with dairy revenue protection. If it's in the near quarter, dairy revenue protection is not available to you, but you can still grab some of that if those prices have happened to jump up quite a bit. You can put a floor under some of those milk prices with relatively inexpensive options if they're nearby options. So look for those, and we may not see much right now, but perhaps in the future of this next year. Finally, the last comment I want to make is about the producer price differentials in milk checks. We have had, since June of 2020, substantial negative PPDs. And in fact, it really wasn't until we got to December that we had our first non-negative PPD. We had quite a stretch of negative PPDs in Order 30 and in fact most of the orders that pay on a component basis. Now, we can't always tell exactly how negative the PPD is going to be. It's a simple accounting exercise, really. It's looking at the value of the pool, how much dollars were pooled in your federal milk marketing order minus the Class 3 price that you're paid the components out of. And if the Class 3 price is bigger than the pool value, your PPD is going to be negative. This creates an incentive for cheese plants to think about depooling their milk. That means electing to be out of the federal order regulation. Why? Because they would have to contribute that negative PPD value to the pool for other plants to take to pay their dairy producers. So we've had depooling that takes place. I've estimated this two different ways here, one with no depooling and one with complete depooling. If you get a lot of milk that's depooled in an order, it takes some value out of the pool and as such, it makes the negative PPD even larger than it would otherwise have been. You can see clear over in the right-hand column what the actual PPDs have been. They fall somewhere between no depooling and complete depooling out here, so it indicates that not all plants or not all milk has depooled in an order. You'll also notice that forecasting on ahead, January is going to have a fairly large negative PPD, in part because prices are increasing in January, or we expect them to increase. As those prices for class 3 and 4 begin to come closer together, the negative PPDs get smaller and smaller until they become forecast to be positive in June of this next year. So PPD negatives are going to be with us for a little bit of time. 2020 in the rearview mirror. From the calendar, yes, it is in the rearview mirror. From the impacts of the pandemic, not just yet. We still have a strong pandemic impact that's happening, and I think we'll have the carryover impacts of recession and just a lot of volatility that we have seen. Not always just in prices, but the volatility of markets themselves. What will 2020 offer? I think reasonable prices, but they aren't going to be great. And we may see much more volatility than my forecast shows. Again, I'm Mark Stephenson. I'm the Director of Dairy Policy Analysis at the University of Wisconsin.